Hi, good morning. This is Avdesh Naga, FinanceAja, your financial planner once again. Today, we are going to talk about asset and liabilities. Sometimes we acquire or we make an investment thinking that it's an asset, but actually maybe a liability. We might end up incurring more money on this asset than the return which you get. So today, we'll talk about evaluating while making investment decision whether take an asset, how to avoid the liabilities. So asset is something which gives us more than what we pay for it. So let's say you buy a car or you buy a real estate and you borrow against it and you are paying an interest on it. Do you evaluate that whether you're actually able to earn more than the cost of interest which you're paying for it? If you are not, then you have actually taken a liability, you've not taken an asset. Because even after acquiring so-called asset or investment, you are still spending on that. So please evaluate your asset and liabilities. At least evaluate against the risk-free rate of return. So when I say risk-free rate of return, so if you are taking any asset, see what is the alternate return you would have got. Maybe in a bank FD, which is safer option, or Government of India bond, safer option. Current interest rate are around 7 to 7.5%, which you can earn out of that. You must evaluate whether you will be earning more than this or not on the asset you are taking. Or if you are taking a loan for that asset, maybe for a house, a loan may be 8.5% in the credit. Okay. You have to evaluate whether you, so while you buying a house property on a loan, you have to evaluate whether you'll be able to make more return than the cost of loan which you have taken on. If you're not able to make return, then probably you're taking a liability, not an asset. So typically a real estate residential property, rental yield is something like 2.5% per year. A property of 2 CR probably fetches less than 50,000 rupees per month kind of rent. So that's true anywhere in the India. So you can evaluate it. It's going to be 22.5% kind of rental yield which you get on your residential property. On top of that, there is a cost of maintenance and taxes which you pay to municipal corporations. So you really need to see what is the real return you are getting out. If your property doubles in 10 years' time, which sounds very good, but it's actually a rate of return of 7.2%, you would have got in any other financial instrument or any other FD or fixed income instrument, gold, silver, metal, bonds, these would have also given you better return. So I'm not saying real estate will not give a better return, but you really need to see what is the return you have got. If it's doubling in 10 years, it's 7.2% kind. And on top of that, your rental yield is 2 to 4%. So when you buy any assets, be it real estate, be it gold, be it mutual funds, stocks, bonds, any other asset which you can think of, you have to see what is the alternate return you would have got it on this, which is like your FD or your bank deposit return. And if you have taken the loan, are you going to get better than the loan return or FD return or not? If you're not getting, it's actually a further liability for you for acquiring that asset, because even after acquiring the asset, you are paying for it. And if you are getting more return than that, then it's actually asset, otherwise it's a. So friend, please identify your asset and liability very well. Do not indulge taking more liability and paying for it. If you want to build a long-term wealth, it's a simple evaluation, simple mathematical evaluation, which is going to help you. So in case of any other queries, please contact us and given coordinates. We always help our client in the best way possible. And we are your fund and financial guide for you. Thank you.